Hello, everyone, and welcome to today's seminar, which is how to get the most out of your Australian super if you live in the UK. So just before we start, just a couple of T's and C's. So first of all, obviously all the content today is for information only. It can be used obviously for kind of personal use. We just rely on the legislation as it is today. So if anyone's watching a recording of this webinar in future, some of the detail we give might well have changed. So just kind of bear that in mind, please. So today's presenters, first of all, it's myself, Paul Davis. I'm Financial Planning Manager here in the UK and one of the founders of BDH Sterling. And joining me today is my colleague, Paul Lawson-Tyers, who has like 30 years experience in UK financial services, at least 15 or so on the Oz UK Oz advice side of things. So today's agenda, what we're going to be looking at will be the Australian super withdrawal regulations. We'll be looking at some retirement and income planning, as well as pension contribution strategies, reversing the direction, obviously for people that are moving between the UK Oz UK, emphasising a little bit about the value of getting advice, a little bit about BDH Sterling, and then we will be closing off with a question and answers section. So if you could drop any of your questions into the Q&A box that you should have, I don't know whether it'll be at the top or at the bottom of your Zoom, but anything, any questions, anything you've got, just dropping at any time, and we'll be addressing them at the close of the presentation. So first of all, we're going to just jump right in with the Australian super withdrawal regulations. So first question, I guess, or first point is conditions of release. What is your preservation age? So in other words, when can you get hold of your Aussie super? So there's a few rules around that, and there are a few exceptions with regards to ill health and maybe even financial hardship. But the condition of release or preservation age is generally 60 if you are retired, 65 if you are still working. And there is like a transition to retirement in between that, where you can access some of your benefits before then. I'm going to go on to a separate slide, which will talk a little bit more about condition of release in a second. The next thing to consider is how your super would be taxed as a UK resident. So there's a couple of things to consider. The first is foreign service relief, and the second is the taxable and non-taxable component of your Australian super. Now, when we're talking about these aspects or the taxable aspects, we're talking about from the UK perspective rather than from the Australian perspective. And that's because I guess partly this webinar is focused on people who are resident in the UK whilst taking benefits. So it's slightly different rules if you're in Australia and accessing those benefits, where generally speaking, once you meet preservation age, it will be tax-free. But if someone is based in the UK, there are a couple of things to think about. So first of all, there's a period up until where your benefits will have accrued, where you will have a relief. And as far as we know, as per the last UK budget that we've just had, that hasn't changed. So benefits accrued up to and including the 6th of April 2017 will not be treated for tax. Anything accrued after the 6th of April 2017, there will be a taxable component, albeit there will be a 25% tax-free amount on that as well. One important thing to consider is that if you have previously transferred UK pension benefits into an Australian super, the rules work slightly differently around that, but that's something we can advise and touch upon. As promised, I did just say just a little bit around the preservation age, and I'm aware that some of you might have already been in receipt of super withdrawals, and you may have been in a position to receive those super withdrawals before the age of 60, and that's because there was a transitional period between people born from July 1960 up until July 1964, where you could actually, your preservation age and retired was earlier than 60. As you can see from this slide, it's where it kind of phased in. But given that everyone now born after 1964, we're exactly 60 years away from that now, the preservation age moving forward is just straightforward 60. So this is just an FYI for those who might have already taken their benefits before then. Also, as I previously mentioned as well, it is possible to take benefits between the age of 60 and 65 if you are still working, and that's a phase known as transition to retirement. The situation there would be, though, you could only take up to 10% of your funds value if you were per annum if you were still working and between the age of 60 and 65. So they're kind of the key points from the super withdrawals. Is first of all, if you are making withdrawals, you will be able to have a component of that point from when you take out tax-free. That's assuming you have your withdrawal includes a part that had accrued up to and including the 6th of April 2017. And anything that's accrued after that, there will be a taxable component. Again, this is in the eyes of HMRC. Those component parts don't exist in Australia if you're withdrawing your super from Australia. It's just from a UK HMRC perspective. And just to add that to that as well, that's if you're going to withdraw as a lump sum. If you're going to take as an income stream, then it's thought about or treated as kind of a slightly different from tax position as far as HMRC are concerned. There is one other exception as well. So if anyone here worked in Australia just under a temporary residence basis, then it would be a slightly different situation there. So it is possible to make a full withdrawal from your Australian super if you were a temporary resident at the time you were in Australia and remained a temporary resident right up until your departure. You can actually take your benefits out all in one go. Whether it's advisable or not, again, we can speak to you about that, but there would be tax paid on that by or from the ATO, the Australian Tax Office. Okay. So I'm going to move on now to retirement and income planning. And for this, I am going to hand you over to Paul Lawson-Tyers.
Yeah, hi everybody. Thanks for joining us today. So yeah, I'm just going to go through retirement income planning a little bit with you. Paul, can I have the next slide, please? Thanks. Okay, so when we're looking at retirement income planning, we need to initially ask quite a number of questions to establish exactly what the plan's going to be going forward. So, for example, when and where do you want to retire? Now, with the nature of the people that we deal with and that will be on this call today, the where is particularly important. Are you likely to retire in the UK? Are you likely to retire in Australia? Because that will make a real difference to what we do in the interim period, and what you do then going forward in retirement, particularly in terms of different tax treatments in the two countries, etc. And then the when is simply, when do you actually want to retire? When might you have to work until, depending on what your financial situation is. We'll go through some proper financial planning with you to work out when you're able to retire, and then it comes down to when you actually want to as well. And what will you do in retirement? Will you go and buy a yacht and sail around the world? Because if you're going to do that, we need to make sure the money's available right at the beginning of your retirement, but you've still got enough for the rest of your retirement as well. Are you going to take up a hobby that's going to be a bit more expensive? You become a golfer and you want to join the local golf course and you've got the annual fees for that. So we need to take into account all of these things when we're working out what the level of income is that you're going to need in your retirement. How long will the money need to last? Now, a lot of people underestimate how long their retirement could be. A lot of people will say, well, I'm 60, I'm probably going to live for 20 years. Now, in financial planning, we always used to go to the average life expectancy, which is around the mid-80s at the moment. But more and more, we're thinking in terms of planning right up to age 100, which sounds a bit daunting, but the average is at 85 for a reason. There'd be some people that die a bit earlier, some people that live a lot longer. And so we just really need to assume that your retirement is going to be longer than you expect it to be, and make sure that you're going to have the money throughout that retirement to be able to fund your lifestyle. Again, a lot of people think that they're going to spend a lot more money in their early retirement and then it's just going to gradually go down. But what if later on in life what if you do live a long life and your care costs, for example, might go up towards the end of your life? So there's something called the retirement smile, which is basically expenses start high at the beginning of retirement because you're doing lots of things. It goes down and then it goes back up again towards the end of retirement. So we need to take all of these things into account and work out exactly what a sensible income is that you can achieve, and how we go about doing that in the most tax efficient manner, etc. Paul, next slide, please. Okay, so one of the ways that we do this to establish how much money you're likely to have in the future and what you can afford to do is to do cash flow modeling. And I'll show you an example on the next page of what it looks like. But basically, we plug everything into it in terms of your income, your expenditure, what you think is likely going to be your expenditure in the future. That includes any withdrawals that we're potentially going to make from the Australian super fund. We do the calculations, as Paul was saying earlier, there's certain different taxable components of it. So what's a sensible amount to draw each year that keeps you within certain tax brackets, etc.? Where else does the money come from in your retirement? So we'll plug all of this in, and then also known expenses. It says on here university fees. If you've got a child that's going off to university and you know that you're going to be helping them out financially, we need to put that in there. Maybe even things like you're going to buy a new car every 5 years, various different things like that. If you're moving back to Australia, what are your moving expenses likely to be? Removal costs, flights, etc. Try and put as much into this plan as possible so that we can, as accurately as possible, predict what your future situation will look like and whether you've got the money to meet that need. And if you're maybe borderline or something, how can we go about maximising the investment returns, the tax position, etc., so that you can get to that situation where you're able to produce the level of income that you need and want in your retirement. Next slide, please. So on this slide, I said that there'll be a couple of examples. So on the right-hand side there's two examples, and the black line that runs across the top of each of these bars, that's basically the income requirement as assessed once we've plugged everything in and taken into account certain expenses that might happen in different years. And each of those blocks is a different year. And you'll see in the top one, there's a whole area of red towards the end. Now, that's something that we don't want to see in the cash flow modelling if we can help it. And if we do see it, we try and find ways of rejigging things so that it becomes less of a problem or not a problem at all, because that is showing the blue lines are basically showing your actual ability to meet that expense. So it's got money running out in the red at the end, whereas the bottom one shows that the assets that you hold and the income that you've got coming in would be able to sustain the level of income that you want in your retirement. So once we plug everything in, your initial situation, your current situation in there, and the way that your investments look and the types of investments that you're in, the tax positions of them, etc., we can then run what if scenarios. So what if you retire at age 55 rather than age 60? What if you spend that money on the yacht and go and sail around the world? Can you then afford the rest of your retirement? So we can run these various different scenarios to see what it's then going to look like and whether we're able to achieve your objectives. So it can become a really powerful piece of software. Believe me, the example on here is quite simplistic. It can go into a lot more detail than that in terms of where exactly all the income is coming from and what your assets look like. So if we look at this case study here, so we've got Mr. Smith. He's age 60, retired, and he's got a super in Australia. He worked over there for 30 years, so it is the bulk of his retirement funds. He hasn't had an opportunity to build up much up in the UK. Now, the first thing that we need to do is to remember that there is a double taxation agreement between the UK and Australia. So Mr. Smith is living in the UK, so he will be subject to UK taxes on any withdrawals that he makes from the super fund. As Paul was saying earlier, there might be some reductions to that, depending on the periods of service over there and what falls pre and post 2017. But the taxing rights are with HMRC, so we need to consider that first of all, and then the foreign service relief that I said, the pre 2017 bit, and then we have to remember that the Australian super, any withdrawals that we make from that, yes, there's certain tax concessions with the foreign service relief, but there could well be an element that is still going to form part of your taxable income. And we need to consider how that interacts with the other taxable income you've got and what sort of tax brackets that puts you in. And maybe, if you don't need as much income coming from it, in this case, it might well be that that's his main source of retirement funds, but this doesn't say what his expenses are, what his objectives are, etc. So we need to think about it and perhaps try and keep within lower tax brackets where we can, if at all possible, depend on other assets that are available, like for example, ISAs and UK pension funds and things like that. So yeah, we need to work out where it interacts with other things to work out the tax position and what's most sensible to do with it. So looking at while you're in the UK and you're still working, well, there's a real opportunity to contribute towards pensions in the UK. Now, this becomes even more important if you are intending to move back to Australia in the future, because if you are, then any tax relief that you can get on your pension now on contributions it could effectively be free money. and any growth that you get on that as well, because we have the opportunity to then transfer the funds over to an Australian super fund. And if you're a resident in Australia and drawing from the super, it's completely tax-free. So you get your tax relief now, maybe even 40% tax relief, depending on how much you're earning. And then you ship the funds over to Australia and get them tax-free. So you live the best of both worlds, and that can be a really good opportunity to make yourself some money. So there is a maximum on how much you can contribute towards a UK pension, though. It is £60,000 a year, or 100% of your salary, depending on which one is the lower. So, if you're only earning £30,000 a year, you can only contribute £30,000. But if you're earning over £60,000 and you haven't contributed the maximum in the last few years, we could potentially go back to those years and use unused relief. You still can't contribute more than 100% of your salary. But if you're on a higher salary and you can afford to put a lump sum into your pension, as I said, any tax relief you can get at the moment could be a real bonus. Even if you stay in the UK, it can be a bonus if you're a 40% tax payer, and you can get that tax relief. And then in retirement, you might be a lower rate taxpayer. So although, and 25% of the fund comes back to you tax-free. So you get 25% tax-free. The other 75% may well only be taxed at 20% at that time, and not the 40% tax relief you got up front. So it's still a really tax efficient place to put the money. And then potentially, as it says on this slide, if you've maxed out that and you've still got some money that you want to put into pension, could potentially top up the super fund that you've got in Australia. But that's only really going to benefit you if you're going to move back to Australia in the future. If you're staying in the UK, it might be better to use other vehicles such as your ISA allowance of £20,000 a year. So yeah, we would work with you to find out what the most sensible way of funding your retirement is. But it just gives you an idea that there are some good opportunities here. Next slide, please, Paul. Okay, so I mentioned earlier about doing the cash flow modelling and working out what you want to do in your retirement. So it's really important to work out where that income's going to come from, because I mentioned about the Australian super and seeing how that interacts with other income. And it's all about just trying to work out what the most sensible option is. So a lot of people will naturally go to their pensions when they reach retirement because that's what you've been saving for. You've put the money into the pension because that's what's going to fund your retirement. But by the same token, you might have built up other investments, like, for example, the ISA. If you've been paying the maximum into an ISA and you've had it for years, you could have quite a substantial amount in an ISA by now, especially if the investments have done well. So should you perhaps be drawing some out of the ISA, as well as some out of the pension, or just entirely out the ISA to start with, depending on what your expected future tax position is with other assets, and particularly if you're planning to move back to Australia at some point, not being taxed on the pension withdrawals in the UK could be a good idea, because if you wait and transfer it over to Australia when you move there, it will then be tax-free. So what's the point in paying tax now if you've got a whole load of ISA funds? So and the same thing with drawing out your Australian super. If you're in the UK but you intend to go back to Australia in the future, why pay any potential UK tax on it? So we really need to work out where the income should come from, being sensible about it. And even from a pension, 25% of it comes to you tax-free, but you don't have to draw all of that at once. You could each year draw a combination between a little bit of lump sum and some income. Maybe even the income element falls within the 12,570 personal allowance in the UK, so you don't pay any tax on that either, as well as the lump sum that you're receiving. So there's different ways to look at what you should withdraw from what product, what the tax position is, what you're trying to achieve, etc. So yeah, hopefully all of that I've run through with you will give you a better idea of some of the things that we can consider and some of the things that the financial planning will help to achieve for you. Next slide, please, Paul. Oh, okay, I hadn't finished. Apologies, everybody. I was wrapping it up there, but so yeah. Paul mentioned earlier that you can go into this transition to retirement between age 60 and 65, where you've reached your preservation age of 60, but you haven't got to the point where you can draw out regardless of your income status. So in this, looking at a case study, so we've got Mrs. Jackson. She's 60, so she'd reached her super preservation age, but she's still working, and therefore she can't take full benefits from the super, but she can go into the transition to retirement, and she's able to draw 10% per annum from it. Now, because she's still working, and she's still got therefore income coming in that can justify a pension contribution. Remember earlier that I said you can only pay 100% of salary into a pension. Because she's still got that income coming in, it means that she can contribute towards the UK fund, the UK pension. So she's got 150,000 in her super. She's allowed to take 10% per year, so she takes 15,000 out, and then she uses that to make a UK pension contribution and receives tax relief on it. So if she's a basic rate taxpayer, she would save 1,538 by doing that. If she was a higher rate taxpayer, it'd be 3,076. The one thing that this slide doesn't necessarily cover is that withdrawal from the Australian super, and whether or not there was any foreign service relief in that, because that would determine what tax did she pay when she actually withdrew it, and how much of a saving therefore is there in actually paying it into the pension fund. But it still could be a very good way of doing it, yeah, certainly something to be considered. And if you're in your last year of work, there could be some advantages to doing particular advantages to doing that, or the last couple of years. So yeah, it's as I said, there's lots of things to consider, but hopefully that gives you a good overview. And Paul will talk to you later about how you get in contact with us to maybe do some of that cash flow modelling that I was talking about. Back to you, Paul.
Okay, so thanks very much for that, Paul. As kind of spoke about slightly earlier, people do move between the UK and Australia, and then back from Australia to the UK. So there are a few things to consider when people are kind of moving between the two, outside of super, but we'll include just some thoughts again on super, because that's the title of this presentation, within some of those thoughts. So first and foremost, supers cannot be transferred back to a UK pension scheme. So we, as a business, we do help and we do advise a lot of people moving from the UK to Australia, and what is the best point or thought that they can have or do with their UK pension. But that would involve either it remaining in the UK or potentially transferring to a super. Unfortunately, supers can't transfer to the UK. So a couple of considerations there is that if you've got a super and you're a UK tax resident, it would be paid to you from that super kind of as an income withdrawal or a lump sum, but it wouldn't be transferred to a UK pension. So it doesn't work both ways. One of the other considerations to think about in that case, if you're not at preservation age or a position to take withdrawals, is whether those funds are invested appropriately within your super. question whether there's anything held in your super. It could be anything from property or to insurances or anything like that, which may or may not be an appropriate investment for you now and your change of circumstances. Change of circumstances being having moved from Australia back to the UK. So it might be that even if you're not on the point that you can withdraw your benefits, that you might need some advice around your scheme. Finally, can you return to Australia and take super as a tax-free lump sum? Well, if you are returning to Australia at any point, or you know you're returning to Australia to retire, it might be something that you consider when thinking about your super, is whether you do actually need to withdraw the benefits from it whilst UK tax resident. So again, if someone's firmly decided that they're staying in the UK, then a lot of this presentation is obviously geared towards those individuals. And, you know, I think the retirement planning and the cash flow forecasting that we mentioned earlier will come into play for you, and when and how to take it. If you are considering moving back to Australia on a permanent basis, then it might be more tax efficient to you to wait until you return. Just a couple of other things to think about. So if you are permanently resident in the UK, or you're considered what's known as a UK domicile, you're indeed, or your estate would indeed be affected by UK inheritance tax. So if something happened to you and you were considered a UK domicile, some of your assets, and it might be more assets outside of super, might be considered as to form part of your estate. So something to think about. We do have a separate onto our business BDH tax, which can help individuals establish or talk about establishing what their actual domicile is. So it's something to consider if you're concerned about inheritance tax in the UK. So the value of advice. So what people know and what people don't know can sometimes be two different things, and a little knowledge sometimes can be a little bit dangerous. But what we can do is, with our professional advice, help people define goals and priorities for the future. We can create a detailed, bespoke plan addressing what's important to you. So I think we touched on that with the cash flow planning and forecasting. We can put in various goals, known capital expenses in the future, and just give you an idea of what that would look like, including your timing on retirement, or I think Paul touched on, like, maybe if you want a round the world trip, it could be your planning, and the advice that we can put together could be as pragmatic or aspirational as possible. But the idea is the advice we give you based on the assets that you have gives you the confidence that the plan will work for you. And then just a little bit about us, really. So we're dual licensed advisors, so we can, and that's in Australia and the UK, so advice can be provided under the one roof. So we'll be able to advise you on both sides of the world. We can, as I think touched on before, we can talk about Australian super. We can provide tax advice. So we've got another onto our business BDH tax that can look at that, and retirement planning for people who are planning to retire either in the UK or Australia. We've got 15 years experience in UK pension transfers, which is very important for people who are moving maybe more in the other direction. And we are defined benefit pension scheme specialists, which means we can actually advise people who might be in the UK who have a final salary or defined benefit pension. And so if you've got any questions or queries that come up after today, obviously we're going to go through a few question and answers in a minute. You can email us at inquiries@bdhsterling.com and just give us like a broad idea of kind of your age and what you're looking to achieve, or kind of advice that you would like. So what I'm going to do now is I'm going to move across into the question and answer session, and just going to go into the boxes there and just see what we have, and if we can help and maybe answer. It might be a benefit not just for anyone asking the question, but for people who are still joining us on this. First question: will recording of the webinar be available afterwards? Yes, it will be. Next question I have is, in terms of the amount accrued after the 6th of April 2017 for UK tax, so presumably with regards to withdrawal on the super, will this include all accrued monies from both contributions growth and interest on the base amount as at the 6th of April 2017? So the answer to that, interpreting it correctly, is yes. So you would have accrued funds up to and including the 6th of April 2017 in your Australian super, with a combination of employers' contributions, employees' contributions, and investment growth. Up to the 5th of April 2017, that is the amount that would be considered for foreign service relief. Anything that's accrued after that, so that could be ongoing fund growth or additional contributions or any other injections of cash into the super, would be considered as post 6th of April 2017 accrual. And hopefully I've kind of touched on this question, but I will touch on it again. Please explain what benefits accrued to April 2017 means. And again, I think that's just pretty much as what I've just said. So just to re-emphasize, if you were living and working in Australia, you would have been enrolled into a super, or you'd have enrolled yourself into a super if you were self-employed, and you would have had employer contributions going in. Hopefully the funds would have been invested and you'd have received investment growth on that, and anything up to and including the 5th of April 2017 would be included under kind of foreign service relief. Anything that's increasing the fund after that would not be included for foreign service relief. Next question I've got here. If you move back to Oz, at what point does HMRC stop being able to tax you on your super money? Does it matter if you move pre or post retirement? As far as HMRC are concerned, if you're no longer UK tax resident, they won't be taxing you on super withdrawals moving forward from the point you cease to become UK tax resident. So if you're back in Australia, it's under the jurisdiction of the ATO, not the Australian Tax Office, and not HMRC. It would be from when you become an Australian tax resident or cease to become a UK tax resident, then HMRC will stop taxing you on your withdrawals. Obviously, they won't refund you for tax already paid whilst you're a UK tax resident, because that was the rules at the time, and that's where you were tax resident when you took those withdrawals. But from the point you move back to Australia, then they'll stop taxing you.
Yeah, just to be clear on that one, if you're an Australian citizen and you're moving back to Australia, then pretty much the day well, it is the day that you arrive back in Australia is the day that you become an Australian tax resident again, and UK doesn't. So usually people have, it's not completely clear cut, but usually people just have a split year essentially. So for say the first half of the year they were a UK tax resident, the second half of the year they're an Australian tax resident, and it's just dealt with in that manner.
Okay, so the next question, please recap how much UK income tax is paid on Australian super. So there's a few factors involved on this. And again, to recap, your funds from HMRC's perspective that you've accrued in super would first step would be split into pre and post 5th of April 2017 rights, and then the taxable amount will be anything that was accrued from the 6th of April 2017 onwards. That accrued amount, that taxable amount, 25% of that, as the rules stand at the moment, would be tax-free as well. So again, that post-pot will be broken down again, and then from the balance of that, the fully taxable amount, how much tax you pay would, and I think Paul touched on that in his slides as well, would depend on what rates of tax you're on at the point of withdrawal. So it will just fall into your normal tax rates. Obviously, you get the personal allowance, basic rate band, higher and additional rate band. So it will just fall into those bands depending on what the what rate of tax you're paying. The next question. I have not touched my Australian super since I returned to the UK in 2017. I'm over 65. Can I convert my super into a lump sum and receive it tax-free in the UK? So potentially, again, that's something we would need to provide advice on, because as I said before, you would have accrued your fund or contributed up until 2017, but your fund would still have an increasing value since 6th of April 2017, as I say, and that component would be the taxable component. So again, it's a key thing. So yes, you might have returned to the UK in 2017. Everything you'd have contributed to and grew up until that point would qualify for foreign service relief. But of course, you're going to have, well, maybe you haven't, but hopefully you have had some sort of fund growth or accumulation since then. And that's when we're talking about the taxable component.
Yeah, so the next question that we've got in there, it's from an anonymous attendee, but it's to do with Asgard benefits in Australia. So with that particular one, I've read through your query there, and obviously it is quite specific to yourself. So what I'd suggest is get in contact with us, and we'll be happy to see how our Australian offices may well be able to help you with that. So we can put you in contact with one of the advisors over there who can discuss your requirements with you. As I say, it's not really one to answer in this webinar, but it is something that we can potentially help with.
Next question. With the 6th of April 2017 in mind, do we need to get a valuation from the super fund at that point? So that's something obviously we can do for you. The short answer is yes, but there's a couple of things to consider, not in terms of that kind of base value or cost, if you like. What is the value of your fund up until the 6th of April 2017, and that's also the exchange rate is a factor on that, because of course if you are assessed for tax in the UK, HMRC will be looking at what the GBP, the pound value would be on that rather than the Australian dollar. So there's that kind of actual additional element to think about on that as well. So next question. So retiring in Australia next year, but considering returning to the UK after 27 years. If returning to the UK, should I take out Oz Super in a lump sum, and will it be taxed? So very important point. So if someone is, as I think we touched on it on a previous answer on this Q&A, but if someone is an Australian tax resident, when they take out benefits from their Australian super, the taxing rights are with the Australian tax office and not with the UK. The next question is, oh, I think I might have missed one. Did I miss someone's question, Paul? No.
No. So the next one is there any top limit in the amount that you can have in this Australian super fund? Well, there is a cap of one, which is currently $1.9 million. That's gone up quite rapidly since it was introduced a few years ago when it was 1.6 million. Now that's the maximum that you could put into the retirement stream, as they call it. Your fund can grow in excess of that, but you can only put 1.9 into the retirement stream, which if you were living in Australia is tax-free. Anything you draw in addition to that will be subject to tax.
Okay. The next question, if pre-2017 super is tax-free, must this be taken only as a lump sum and not as an income stream? So if you are a UK tax resident, the rules that we've been discussing today around foreign service relief and pre and post 6th of April 2017 components really does apply if you're taking out funds as a lump sum and not as an income stream. That falls at a different part of the in the kind of UK income and tax earnings, income and tax manuals on the HMRC website. So we are really talking about lump sums here. So again, before you make withdrawals, or if you're considering make withdrawals, it is really important to acquire some sort of advice first. Right. Let's Right. The next question I have, can an Australian UK dual national claim foreign service relief as they accrued super whilst residing as an Australian national? So again, I think what we really need to get kind of establish here is when these rules do and don't apply. So it's really down to someone's tax residency rather than whether they're an Australian citizen, UK citizen, or dual nationality. The rules around withdrawals from a foreign pension, or in this case, your super, if you're a UK tax resident, apply if you're a UK tax resident.
The next question is, how much time can I spend back in the UK once I move back to Australia and not be caught by HMRC? Well, there's all sorts of rules that go over the top of it that determine tax residency. Now, initially, when you first move back to Australia, if you then come to the UK within the first year or two, you're going to be very restricted on the number of days that you can spend in the UK before you become a tax resident here again. And that gradually eases over time, but there are various other layers that get put over the top of that. So really, if you're in doubt about what sort of position you'll be in, and you really want to have a much clearer idea, that might be where you might benefit from speaking with our sister company, BVH Tax, who are duly qualified accountants in Australia and the UK. So they can do a piece for you if it's a particular concern. that will address your tax residency and how much time you spend in each country in your specific circumstances. Because there's all sorts of different rules to do with ties to the UK and property over here, etc.
Thanks, Paul. Then the next question I have is, how do you structure your advice fees, and do you offer fund management services for clients such as managing ISAs, etc.? So, second part of that question first, yes, we do offer a full range of UK financial planning services, including using the most appropriate tax wrappers and investments that are appropriate for the individual that we're advising. Essentially, we are UK financial planners. We're in fact chartered UK financial planners, authorised and regulated by the Financial Conduct Authority. We do straightforward financial planning for people who are not moving, or have no connections with Australia at all. But I think it's true to say about 80 and 85 to 85% of our clients across our offices here in the UK and in Australia have a UK, Australian UK connection in some shape or form. And to go back to the first part of that question, in how do you structure your advice fees? Well, we, and as Paul demonstrated, we can offer like a full financial planning service, including kind of cash flow forecasting, where we kind of look at people's objectives, their aims and their goals, and we charge full financial planning fee for doing that area of work. We can, in isolation, just look at super withdrawals and the taxation on them. Obviously, it's more useful, I would suggest, to someone if it kind of falls within their financial plan and cash flow, just to give it some context. But we can just offer a standalone Aussie withdrawal service, Aussie super withdrawal service, as well as the full financial plan. And if you amalgamate the two together, you will get a discount on that. But I can speak to people about our cost, charges and fees separately through inquiries. The next question is, how do I show HMRC what I'm withdrawing from Oz Super? So there is actually a form that you can complete, and we can actually help you to complete. It's on the HMRC website. I think it's SA16, but don't quote me on that off the top of my head. It's something we can actually help and advise on, and it's for all kind of. And it's a form where you declare after the tax year that you've received any foreign income in. So that could be anything from like dividends, proceeds of shares, royalties, but there is a section carved out for foreign super. So there is two sections on taxable and non-taxable amount on that form. You would typically submit it by, I think, the 31st of October after the tax year that you received that income. But that's something we can actually provide help and advice on. And if you do use us for super withdrawal advice, that would come as part of the advice. Next question. Can you move the pre-2017 component part into the UK and leave the post-2017 component part in Aussie Super? That's a really good question. The short answer to that is no, you can't do that. So whether you make a full withdrawal of your fund, or if you're going to do kind of an ad hoc lump sum withdrawal, there it will always be, whatever that withdrawal will be, it will always be proportioned between the pre-April 2017 component part and post-April 2017 component part. Next question is, how do we find out how much the super fund growth was from the 16th of April 2017 onwards? Well, that's something we can look at the calculation for you. I mean, essentially, it's going to be the difference between the value up to and including the 5th of April 2017 and what the exchange rate was on that day compared to the actual value on today's date, including today's exchange rate. So it's going to be the difference between the two. But that's something that we can provide in terms of our advice, the calculation behind that.
Paul, I'm just going to move over to the chat because I'm conscious that there's a few comments that were made.
Okay, fine. Far away, yeah.
We're a bit earlier than the ones that we're answering at the moment. Apologies, people. We should have said that that everything should go in the question and answers at the beginning, but I'll get to the ones on the chat. So first of all, Tony asked, he said, I'm in my mid-30s and have just moved to the UK and intend on living here for 5 to 10 years. I plan to retire in Australia. What is the best super strategy while living in the UK? In simple terms, as I said earlier in the bit that I was doing, in simple terms, it's probably paying into the pension in the UK and getting the tax relief that you can get at the moment, then transferring the funds over to an Australian super and getting them tax-free in your retirement. But it may well worth be having it, have a chat with us about it, and we can, we'd be happy to have an initial chat through it and work out whether there's some planning that needs to be done there in terms of where you put the money. The next one is, I'm 61 and left Australia before 2017. I have approximately 60,000 in my super and I'm still working. I'm looking at the transition to retirement. You indicated 10% withdrawal per year. So it would mean drawing £6,000 for 4 years, or $6,000. I'm not entirely sure if it's pounds or dollars, for 4 years, then remaining. As it's such a small amount, is there any way to draw the full amount before I'm 65? Well, I guess the easy answer is stop working. Because if you might well be able to draw it then. But yeah, if you're continuing to work, then you're going to be subject to that transition to retirement. Next one, Chris has asked, are there any CGT considerations for Australian super withdrawal if resident in the UK? No, it's not capital gains tax, it's income tax that you'd be subject to on those withdrawals. And obviously that income tax will be reduced by the foreign service relief that Paul went through with you earlier. Mark has said, can you cover on QROPS, please? And would my PTY limited company ATF, my super fund, qualify? Well, Mark, that's not really a question for this webinar, but we'd be happy to talk through it with you. The one thing I will say is that there's only really two QROPS options, so qualifying recognised overseas pension scheme options over in Australia. One is a retail scheme called the Australian Expat Superannuation Fund, and the only other route to go down is the self-managed super fund route. And as long as you're age 55 or above, you can apply to HMRC for your QROPS status, and then you can make a transfer from the UK pension to the Australian one. So yeah, we can have a chat with you about your specific situation, whether that fund that you're talking about is a self-managed super fund. I don't know, but yeah, we can have a look at that. And another question: does the ATO advise HMRC on withdrawals that are made from Australian super? I get asked quite a lot in general terms about all sorts of different tax things. When I'm advising people on withdrawals and where they're going to be taxed, etc. And the common question is, well, how are they going to find out? Which I think that question is basically hinting at. I think it's best to work on the assumption that they're going to find out, and and that if you try and hide anything from them, that you're not only going to have to pay the tax that you were meant to be paying, but you're going to pay a lot more in terms of fines as well. So, Paul, sorry for taking over there, but that's the end.
Right. No, it's important.
The chat. So if you want to go back to the questions and answers now.
I will do. No, thanks for that. Hopefully we'll try and get covering as many questions as possible. I do appreciate that some people have taken their lunch break for this seminar, and it might be that they have to go back to work now. But I will cover as many questions as I can before we finish this. So one point's come in. I just heard from this webinar that the moment I move back to Australia, I become Australian tax resident. My understanding is that I would have to spend a year in Australia before HMRC would have no claim on my superannuation. Does that mean I won't have to live in Australia for a year before I can receive my Australian super tax-free if I were to return to Australia? So I think the key point here is this. So timing's quite important here, because first of all, the UK tax year runs from the 6th of April to the 5th of April. The Australian tax year runs from the 1st of July to the 30th of June. So you would have to really, I think timing's very important as to when you've left one country and you're outside of that tax year to when you've arrived considered tax resident in the other country. So that is something before you take withdrawals from your Aussie scheme. That is something that I would urge you to get advice on. I think one of the takeaways would be you couldn't just like move back to Australia for a few days, withdraw all your funds from your super, and then come back to the UK in the same tax year. That would definitely cause you problems with HMRC. The next question: I'm retired in the UK. Is it correct that if I leave my super in Oz, it's tax-free? I am thinking about leaving it there as funds to use if I say escape a winter or two in Oz. No plan to return to Oz permanently. Is it wise to withdraw, say, 10% annually from my super and transfer to the UK? Well, it all depends on someone's personal circumstances. Before I'd answer that, I'd really need to know about your kind of other sources of income. What I can say is, as your funds, as the rules currently stand, are held and are growing within your super, HMRC is not interested in it. It's just the moment that you start withdrawing from your super, and your UK tax resident, that's when HMRC would be interested. The next question: I am a New Zealand citizen and work there from 16 to 28, then Australia from 28 to 50, and in the UK after that. My super is all in Australia, with a good chunk in the UK that I've saved after 2016. Retiring in Australia about 5 years' time. Are there any considerations? And I should take into account the New Zealand component part of the pension. So look, it all depends. A lot of these things you need to consider would be depending on where you're going to be when you retire. So if you're in Australia when you retire, there is a Trans-Tasman agreement between Australia and New Zealand. If you're retiring in the UK, then we would have to do, obviously kind of a calculation as what is and isn't qualifying for foreign service relief in that respect. Next, how many times can an amount be considered a lump sum before HMRC consider you're taking an income stream? Well, that's a really good question. There's obviously some of that could potentially be open to interpretation, but there would be a clear distinction between ad hoc payments taken at different times of the years, varying different amounts, and regular income, albeit might be annually, which is roughly the same amount every year on the same day. So there's no hard and fast rule behind that, but that's really one of the things to consider. Again, important to get advice on that. If you are regularly taking income because you know how much you need, then it's really going to kind of look like it's like a pension payment rather than an ad hoc withdrawal or lump sum withdrawal. So it's important to take advice if you don't believe you are going to be taking everything as a one-off hit, or maybe in a couple of instalments.
The next question is: do you or your tax arm advise on Australian super withdrawals to UK? It's us. So yeah, if you're interested in having a look into it, then just drop us a line, and one of us will be in touch to discuss that with you. The next one: how much Australian super can I take as a lump sum per year? Well, that, as Paul was going through earlier, it depends on whether you're in the transition to retirement or not between age 60 and 65. After 65, it makes no difference whether you're working or not. You can take as much as you like out of the super. If you're between 60 and 65 and you're fully retired, again, you can take what you like out of the super. What's sensible to take is a different matter, and that's where we need to do the tax calculations and work out whether it is sensible to take the whole lot or not. But yeah, so if you're still working, it's 10% per annum between 60 and 65, but 100% after age 65, regardless of your employment status. And yeah, if you're retired between 60 and 65, it's 100%.
And final one I've got at the bottom is there a standard form to complete so that an Aussie pension fund does not automatically withhold tax in Australia, i.e. how is an Aussie fund informed that I'm a resident for taxation purposes? So I think there's a little bit here to think about. In terms of withdrawals, you wouldn't get taxed at source by the ATO. In terms of fund accrual, because the scheme is registered with the ATO, there is tax on income at scheme rates. So your residency in that respect doesn't make any difference. So any accrual or funds that are held in Australia, unlike a UK pension scheme that grow tax-free, there is a taxable element to that, and I think it's regardless of where the member is resident. When it comes to withdrawal, again, going back to the main bulk of our webinar today, it largely depends on where you're tax resident. I think that's covered everything. There's one I think maybe I jumped over. How much Australian super can I take out as a lump sum per year? Well, again, if we go back to your kind of preservation,
I answered that one just now.
All right. Okay. Fine.
Yeah, it depends on your age. There is one more on there actually. It's just come in from Mark Ferguson. Does HMRC have the ability to levy IHT on someone, their estate, who moves back to Australia, takes all their assets with them, and subsequently dies in Australia? Well, yes. It depends on your situation. If you were born and bred in the UK and you move over to Australia, then you will still be UK domicile for inheritance tax purposes for at least 3 complete UK tax years after you've left the UK. Not anything you can do about that. And
I think it's 5 actually now, Paul.
Oh, is it? Sorry, 5.
Yeah, 5. So you'd have to be over 5 years as one step to looking to what's called break your domicile. But even then, that might not be enough in isolation to break your domicile, depending on what ties you have in the UK. So tax resident is more straightforward. It's where you're living and paying taxes. Sometimes it can't. Sometimes there's complication if you're splitting your years between two countries. But basically, it's where you're resident and paying taxes. Domicile is a little bit more complicated because it's kind of where you're considered to belong to, and you could still belong to the UK long after moving to Australia. Yes, there are steps you can take. Yes, there's that period of time spent outside the UK, not returning. And yes, taking your assets with you would help, but it might not be enough in isolation. Again, that's something we can provide advice on. Now, Paul, I do need to check. I think we've come to the end now.
We've got no more questions.
Okay.
Thank you everybody for all those questions, because you know, that was a good old session there.
Yeah, no, it's very important that for us, when we put on these webinars, that we feel people are watching and they're engaged with the webinar. And sometimes our slides and our presentations does throw up questions. As much as we try and clarify things, sometimes it does throw up questions, but it's quite good. It gets people thinking, and over time, when we see some of these questions coming in, it really does help us then for the next presentation to give us an idea of what to cover or maybe what to elaborate on. So thank you very much for your participation in today's webinar. So wish you all a good afternoon, and as I say, if any questions, we've got email box inquiries@bdhsterling.com. So thank you very much for your time, everyone, today.